Hello and welcome to What Would Peter Lynch Do?, where we explore the wisdom of legendary investor Peter Lynch.
Great to be here.
Today is Friday, May 23, 2025. And, well, the markets are reacting a bit today.
Yeah, following President Trump's comments about potentially putting a 50% tariff on the EU, major indices are all down.
Right, exactly. And it's on days like this, when things are looking red, that doubts can surface. We actually got a question from one of you listening.
Oh, yeah?
Asking, basically, as a non-professional, can I actually be successful investing in stocks? It's a question that really hits home when you see the market tip.
It really does. It's completely understandable. When things get volatile, you're not, a full-time pro. It can feel, well, pretty daunting.
For sure.
But that's exactly what we want to dig into today. We're going to look at Peter Lynch's perspective, of course, but also pull in some other insights to tackle this head on.
Okay, great. So our mission for this deep dive: can everyday people, non-professionals, really make it work in the stock market, especially when it's choppy like today? We'll look at Lynch's ideas and see how they stack up now with, all the modern tools and stuff.
Sounds like a plan. Let's maybe start with Lynch's core philosophy here. He had this idea, almost controversial, right?
Yeah, which one?
That average folks could do just as well, maybe even better than the Wall Street experts.
Right.
He actually said, let me find the exact quote. Here. Stop listening to professionals. 20 years in this business convinces me that any normal person using the customary 3% of the brain can pick stocks just as well, if not better, than the average Wall Street expert.
Wow, 3% of the brain, that's quite a statement. Kind of bold.
It is bold.
So the idea that you or I could beat the pros, what made him so sure? What was his reasoning?
Well, Lynch really believed that individuals have this built-in advantage. Just their everyday lives, their jobs, where they shop.
Yeah.
He said, you can pick the spectacular performers from your place of business or out of the neighborhood shopping mall.
Okay.
And even you know it before Wall Street knows it.
Yeah.
Just think about it. You see things. You notice when a store is always packed or when everyone suddenly has a certain product.
Yeah.
That's real world intel.
That actually clicks. We had a listener mention seeing Teslas everywhere in their neighborhood and deciding to invest based on that. Didn't get in super early, maybe, but still expects decent returns. That feels very Lynchian, right? Investing in what you see and know.
Exactly. That's his famous line. Invest in what you know. And it wasn't just a throwaway phrase. It means putting your money in companies whose business you actually understand, products you use, services you get. He said something like, even if you miss the highs or the lows, you would have done better to have invested in any of the familiar companies than in some of the esoteric enterprises that neither of us understands. Stick to what makes sense.
So, flip side of that,
Yeah.
what's the danger in jumping into businesses you don't get? The esoteric ones.
Yeah, he had a funny, kind of sarcastic way of putting it. He said, basically, if you don't understand it, then put your life savings into it.
Right. Don't do that.
Exactly. Shun the local company you can actually observe and go find something making an incomprehensible product. His point was that's how you lose money. And crucially, when the market drops, you'll panic because you have no clue what you actually own or why.
Makes sense. No foundation.
Get another great line. If you couldn't tell if that was a racehorse or a memory chip, you should stay away from that. If it's just a name on a screen to you, probably best to pass.
Very clear warning. Okay, so what about this idea that, the real secrets, the best stock tips, come from experts gossip? That inside track.
Yeah, Lynch was pretty dismissive of that too. He acknowledged that people might think it's the sophisticated and high-level gossip that experts hear that gives us our best investment ideas. But he felt that usually any inside info an average person hears is probably already out there, or just not that useful. Plus, he cautioned about blindly trusting brokers or experts. Remember their incentives. As he put it, brokers make money whether I make money or not. They trade.
Oof. Yeah, good point.
So it comes back to doing your own homework, understanding things yourself, not just chasing whispers.
It's fascinating that someone like Peter Lynch, so successful himself, basically said, hey, don't just copy me. Why would he advise against following his own picks?
It is pretty humble, isn't it?
Yeah.
He gave 3 good reasons to ignore what Peter Lynch is buying. First, 1, he might be wrong. Even legends mess up.
Sure.
Second, 2, you will never know when he's changed his mind about a stock and sold. By the time you find out he sold, it could be way too late for you.
Right? There's a delay.
And third, and this is key, 3, you've got better sources and they're all around you.
Yeah.
He thought your own observations, the companies you interact with, are actually better sources for you because you can keep tabs on them constantly.
So it's really about developing your own eye, using your own world as the research ground, not just outsourcing your thinking to someone else, even a genius like Lynch.
Precisely.
Okay, that leads me to think. What about the feeling that individual investors, us regular folks, are just small fish in a big pond dominated by huge institutions? Do we actually have any advantages?
Surprisingly, yes. There are several distinct advantages individuals have. Sources like Investopedia and Livewire Markets point these out. A big one is having no mandate.
What does that mean exactly?
Well, as Livewire says, retail investors can invest in any asset class, company size, or geography, or choose to hold cash if nothing looks appealing. Institutions. They often have to invest according to specific rules they're mandated. They might have to stay fully invested, even if they think the market was terrible.
So they can't just sit on the sidelines in cash if they want to?
Often no, but you can. Holding cash is a powerful option they might not have. That's huge freedom.
That is a big difference. And I guess we don't have clients breathing down our necks for quarterly reports either.
Exactly. That's another point. No investor updates or performance pressure. The pros have constant pressure to perform, meet benchmarks. They might even do things called window dressing.
Window dressing?
Yeah, making the portfolio look good right at the end of a quarter, even if it's not the best long-term move. Livewire knows. As a retail investor, you're only accountable to yourself. You don't have that short-term pressure.
Okay.
And related to that is no performance fees influencing decisions. Some fund managers might chase riskier bets to boost returns and get bigger fees. You don't have that conflict. You can be patient.
And what about accessing different types of companies, like smaller ones?
Yes, definitely. Big institutions often can't really invest meaningful amounts in small companies because they'd move the price too much just by buying in. But Livewire explains, retail investors can take advantage of inefficiencies in these under-the-radar stocks without moving the market. You could potentially find hidden gems the big guys can't touch.
That makes sense. And it all ties back to Lynch's main point, right? Invest in what you know. That seems like a uniquely personal advantage.
Totally.
Yeah.
The Livewire quotes Lynch on that. Invest in what you know. Your personal experience noticing trends early, that's a real edge. Plus, you have the power of deep focus. You can really dive deep into one sector or company you care about and become a specialist. Institutions often have to cover everything.
We can move faster, too.
Much faster. Speed and flexibility. As Livewire says, want to buy or sell a stock? You can do it in seconds. Institutions. It can take them weeks or months to get in or out of big positions without wrecking the price. And finally, no career risk.
Yeah.
You believe in an investment, but it goes through a rough patch, you can stick with it. A fund manager might get fired for the same thing.
Okay, so there are actually quite a few potential advantages. Given those, what are some solid long-term principles for non-professionals to follow? I know Investopedia and Faster Capital had some thoughts here.
Right. The key is thinking long-term generally, like 3 years or more. Investopedia warns, resist penny stocks. They seem tempting, but they're super risky and volatile.
Good advice.
They also stress, pick a strategy and stick with it. Whether it's value, growth, dividends, find what fits you and be consistent. Think Warren Buffett and his value strategy.
Consistency matters.
Definitely. And be open-minded. Don't just look at the giant household names. Consider smaller companies with potential, like NVIDIA a while back. Maybe not everyone saw that coming.
True.
And while you should keep taxes in mind, don't let tax avoidance be the main reason you buy or sell something. Good investment decisions come first.
Got it. What about Faster Capital? What principles did they highlight?
Faster Capital really emphasized the power of compounding. Reinvesting your earnings over time makes a huge difference. They also talked about navigating short-term volatility. Basically, don't panic sell during downturns. They're normal if you're in it for the long haul.
Easier said than done sometimes, but crucial.
For sure. Also, low transaction costs, which happens naturally with long-term investing since you trade less. Leveraging diversification, spreading your investments around is key for managing risk. And then there's the mental game, emotional discipline, avoiding impulsive moves based on fear or greed.
The hardest part, maybe?
Could be. And finally, just plain old patience. Good returns often take time.
Okay, that's a solid set of principles. Now, shifting gears a bit, AI. Artificial intelligence is everywhere, including investing. How should regular investors think about this? Is it a help or a hindrance?
Yeah, AI is definitely changing things. Investopedia points out that pros are using it heavily for analyzing data, finding patterns, and these tools are becoming more available to retail investors too, which, could be really helpful.
But there's always a but, isn't there? What are the warnings?
Absolutely. Big warnings. First, AI should be a tool to help your judgment, not replace it. It can't predict the future perfectly, its accuracy varies, and unfortunately, there's a rise in AI investment fraud.
Oh, like what?
Things like scams pushing proprietary AI trading systems with crazy guaranteed returns, unregistered platforms, even deepfakes trying to impersonate experts. So you've got to be careful. Verify registrations, be super skeptical of guaranteed high returns, double check everything.
Good to know. What did the behavioral insights team find about how people react to AI advice?
Interesting stuff. They found people followed blended advice, a human using AI slightly more closely, though it wasn't a huge statistical difference. People weren't necessarily averse to AI advice compared to human advice.
Okay.
But a key finding was that even bad advice, AI or human, could still sway how people invested. And they also noted that, at least in their Canadian sample, people held a lot of cash, maybe too much, potentially hurting long-term returns. It shows we need to understand risk appropriately.
And finally, what about our own built-in biases? Things that trip us up as individual investors. There was a source on behavioral economics.
Right. The measures to protect individual investors based on behavioral economics source, it highlights common biases, like maybe just going with whatever your main bank recommends without much thought.
Guilty as charged sometimes.
Or being overconfident because a past investment did well. Or being too slow to change your mind when facts change. That's conservatism bias. Seeing patterns where there aren't any, based on small examples, representativeness, getting overwhelmed by too much info, and just not deciding anything.
Yeah, analysis paralysis.
Exactly. Or just sticking with what you already have, the status quo bias. The source also interestingly noted that showing fees as actual dollar amounts, not just percentages, can help people make better choices. Like $100 feels different than 1%.
That makes sense. Okay, so let's try to wrap this all up. It sounds like, yes, markets go up and down. It can feel scary.
It can.
But Peter Lynch's core message still holds weight, that everyday people can do this.
I think so, yes. Your real-world observations, understanding businesses you actually interact with, that's a genuine edge. It's not about being a Wall Street wizard.
Right. And while there are pros and fancy AI tools out there, we as individuals have flexibility, different perspectives, those advantages we talked about.
Exactly. The key seems to be blending Lynch's timeless advice. Invest in what you know. Do the research with, a modern awareness. Understand AI's limits and risks. Be aware of your own biases.
So successful investing for a non-professional, it's definitely possible.
It seems achievable, yeah. It takes learning, thinking long-term, staying disciplined, especially when things get rough like today, but it's not some exclusive club-only pros can join.
That's really encouraging, especially for the listener who asked, and probably for many others listening today feeling a bit uncertain. It's a journey, right?
Definitely a journey.
So maybe don't let a down day shake your confidence too much. Remember the principles. Remember your advantages. And speaking of Lynch, let's end with a final thought from him. You already do the fundamental analysis that Wall Street analysts get paid millions for.
A great quote, a good reminder of the power of observation.
Until next time, this has been What Would Peter Lynch Do? Thanks so much for tuning in.
Thank you. Have a great day.